The uniqueness of property and the use of leverage are two elements that make it very, very difficult to really position property on the CAPM model. However, it's important for us to understand the impact of leverage on risk and return, and how, at least conceptually, that should affect the performance of property. If we consider unleveraged property as conceivably starting on the CAPM line, but then we apply debt leverage to it, that will usually, hopefully, increase the overall return. And so leveraged property investment compared to unleveraged will have a higher return. However, the leverage also increases risk. Because the risk has increased, it means that we cannot consider the unleveraged property as the same as the leveraged property in terms of its quality as an investment. It has pushed the investment across to the right on the CAPM model. Exactly how far to the right the leverage has pushed the property is very difficult to ascertain, partly because the increased uncertainty is all in the future, especially when we haven't used leverage in the past. And so we can't rely on historical variance. At least conceivably, we can see that even if we could evaluate it, it's very difficult for a one-off such as property to be able to locate it reliably against something like equities where we have an abundance of information. The only conclusion that we can really take is that the effect of leverage on property definitely increases its risk, but where it increases it to and where it places it on the CAPM model, say compared to the All Ordinaries, the share market, is difficult, if not impossible, to ascertain. In practice, we find this is exactly the question which lies in the market, the allocation between property and equities. There are various studies to suggest that property is more attractive than shares. However, those studies tend not to do any realistic analysis of the amount of leverage involved and whether or not, if we look purely at unleveraged property, whether its supposed modest performance is in fact balanced by the fact that unleveraged property is quite low risk. Unleveraged property only has a rental risk, whereas by the time we leverage the property, we have not only the rental risk, but that is magnified and also added to it the financial risk of where interest rates are going, which changes the whole dynamics of the return process. From this we can conclude that if nothing else, the relationship between property and equities is probably impossible, at least at this point in history, to be able to ascertain directly. The way that leverage affects risk and beta is also less conspicuous, certainly difficult to force into the beta paradigm of the CAPM model. What we know is that leverage tends to improve returns most of the time, and most of the time can be a period of years, perhaps 10 or in some cases almost 20 years. Leverage always looks good. In the recent history, we can see that the use of debt, say from about 1991-92 up until at least the mid-2000s, a period of over 10 years, has been consistently associated with strong profits. However, leverage also increases the cycle risk. In other words, when the business or economic cycle turns down, exposure to high levels of debt considerably increases the risk of failure during an economic downturn. Because these are infrequent and always unexpected, but the impact of being over-leveraged when a correction occurs usually means a major problem for the investor. And so leverage increases the cycle risk and causes these unexpected, infrequent, but major crashes. This doesn't fit well into the 10-year variance approach to evaluating risk. And for this reason, the effect of leverage on beta is very difficult to ascertain, and probably not really directly connected. There have been studies that have shown that company failure is correlated to debt levels, and certainly during the last decade or so there's been ample evidence internationally of over-leverage being associated with company failure, even very, very large companies. When it comes to making the decision about leverage, actual markets tend to react to recent history. And so in the very early 90s, while it was a good time to be leveraged, in many cases investors were reluctant to use debt leverage because of the experience that they had suffered during the crash at the end of the 1980s. This is perhaps likely to be affecting conditions at present or into the near future. A very important strategic tool for managing the risk that comes from the use of debt, and partly from taxation, is the use of limited liability companies. The sole investor or operator, or the partnership, has total control over their business activities, but unlimited financial risk. This is controlled in the case of the limited liability company, either public or private. The limited liability company creates an independent legal person, and because they're an independent legal person, the risks associated with failure are quarantined within the company. The owners don't join with the company in terms of exposure to risks. The limited liability company therefore is able to manage the location of risks, control them, but also manage the financial location of taxation. Limited liability companies have been in use for several centuries, but were largely stylized and put into general use towards the middle of the 19th century. This is significant because the use of limited liability companies, although widespread, is only about 150 years old or so. By that, I suggest that the financial world has only relatively little experience compared to other aspects of international finance. During that 150 years, there has been a massive number of companies that have started, but also we've seen, especially in the last generation or so, a very strong shakedown in terms of the development of a relatively small number of extremely large corporations which are able to have influence well beyond national boundaries. In addition to the limited liability companies, there are a number of hybrid forms. Of these, limited partnerships are a recent innovation where the quarantining of risk and taxation is distributed between a limited liability part of the capital structure and also a partnership part that has unlimited liability. Another hybrid is a joint venture, which is occasionally used for particular projects. Here we're primarily interested in private and public companies, and we'll be looking especially at strategies applicable to private companies dealing with real estate. It's not the intention here to give an exhaustive outline of companies, as these would have been introduced in introductory finance courses and perhaps accounting, but we'll just summarise the basic advantages of operating in a limited liability environment. Generally, more expenses are tax deductible, and you have better control of both tax timing and the distribution of tax liabilities between corporate entities. Lastly, there is of course the limit for debt default recourse. That is, if there is a financial failure, the financial failure is limited to the paid up capital of the company. For many private companies, this can be quite limited, and a private company especially gives its owner the opportunity to control the way that capital is supplied to the company between equity and debt. In many private companies, the equity remains quite low, in some cases as low as $2, while the remainder of the company's capital is supplied through a loan from its owner.
The best way to illustrate the benefits of using a company structure for property investment is to consider a case study. Consider a situation where a chap, we'll call him Adam Smith, lives on 3 hectares of land adjacent to a growing coastal town. The land is ripe for development. In order to separate the development risks from his personal situation, Smith acquires a proprietary limited company and sells the land to the company on deferred settlement. This has the advantage of separating Smith's private finances from the situation of the company. If the land is sold to the company on the high end of the market, given that in any valuation there is always a spectrum of possible values, the development profits will be minimised within the company and maximised as capital gains for Smith personally. This both controls the risk that Smith will be exposed to, but also ensures simplification when it comes to establishing the type of tax obligations, because the sale price will return a strong capital gain to Smith, on which he will pay capital gains tax if applicable, whereas the development company will have its development profits minimised because Smith will need to borrow for the construction of the subdivision. Smith will need to leave sufficient equity in the company to be able to support a loan from a debt supplier, a bank. But this will mean that a major part of the land payment between the company and Smith can be made through a deferred settlement, leaving Smith as a creditor to his company. The advantage here is that by being a creditor to the company, Smith raises his situation in terms of priority of settlement in case the company fails. Being a creditor, he will be on a similar footing to other creditors that have priority over the assets of a company in the case of winding up, rather than as an equity holder, in which case he would only take the remainder. The benefits of this structure is that it becomes easier to ensure maximum development profit subject to capital gains tax rather than income tax. It quarantines risk with the company in case of failure. Most of the profit is taken before the development is commenced, and all risk is left in the company. There is a careful balance that needs to be struck when working within corporate structures such as these to ensure that while risk and tax obligations may be minimised, which is perfectly legal, the arrangements do not go past what is commercially reasonable and stray into the area of tax avoidance, which is illegal and should not be attempted. If for whatever reason the development is a failure, Smith will only stand to lose, as a maximum, that amount of equity that he left in the company. Depending on how long he had owned the land, this could be merely a portion of the capital gain that otherwise would have been taken. Limited liability companies are an important strategy that has come into use in Western business as a result of the prospects of failure due to relatively unregulated lending that has been available since the mid-19th century. When attempting to use strategies such as this, expert and specialised advice should always be taken. However, this outline is intended to introduce students to the general mechanics and possibilities of what can be achieved. The use of debt in the foregoing example is a key component for maximising the eventual profitability of that development project, and if the corporate structure is set correctly, it should also minimise risk. But when attempting to use debt strategies, there is generally a need for careful modelling of the loan and in fact the entire project. The modelling needs to take account of the cyclical nature of the risks that come about as a result of the use of debt. Once borrowers have taken on loans, it is important that they consider their repayment strategy, and this will change depending on their situation and the use of the loan. At various parts of the business cycle, and especially over the last generation or so, there have come about a number of rather aggressive borrowing strategies that have been designed to respond to the demand for extra debt that has been occasioned by a general trend in the community towards indebtedness over savings. This has made it ever more important for some level of understanding of the way that loans and repayments behave, and this can only be achieved by modelling the loan and the repayment strategy. The final element in understanding how to strategically manage debt is to have some understanding of borrower psychology. The discipline of marketing is very good at recognising the way that purchase and most financial and commercial decisions are influenced by psychological issues. While this flies in the face of the rational self-interested individual that is the core of economic theory, it is closer to the real world. In the case of using debt, where it has the capacity to both increase returns but also increase risk, it's important to have an understanding of the psychological mechanics that are at play when people approach banks for a loan. We will look at these points in turn, starting with borrower psychology. We will look specifically at the matter of buying houses. Most people are aware of what is known as the Australian dream, and that is the desire most people have in Australia for owning their own home. Coupled with this over the last generation or so has been an investment dream, which has seen many people in the community aspire to owning at least one investment property. In both cases, heavy debt leverage is required. We can ask the question, how do home borrowers, be they owner-occupiers or investors, approach the bank? It could be argued that a rational home buyer would evaluate their capacity, choose a part of the market, and then approach the bank with the intention of obtaining a particular principal. While this is partially the case, it doesn't completely explain the way that the psychological mechanics are done. Rather than approaching the bank with an idea of a particular principal required based on the aspirations of owning a particular standard of housing, most borrowers approach the bank realizing that they have a particular debt service capacity, in other words, a particular level of repayment that they're able to make each month. And from this they compute, or get the bank to compute, the maximum principal that they would be permitted to borrow. And it is only after they have an idea of their maximum borrowing capacity based on their debt service ability that they then go and look in the real estate market to see what property they can acquire for the maximum amount of funds available from the bank. What this means is that they approach the bank with a constant amount, which is that amount of their income that they are able to pay towards the loan. And the variable is how much the bank will be willing to lend to them, what the loan principal will be. Now, while in practice there is a certain interaction between these two factors, ultimately the fixed reference point in borrowing is the debt service ability. The way the debt servicing ability, the amount of money which is available by the purchaser to repay the loan on a monthly basis, while that is constant, the way that it translates into the maximum sized principal or loan can vary depending on the interest rate and the leverage limits that the bank prudentially sets for lending into the housing market. This is illustrated in the graph on the right hand side of this slide. You can see that as interest rates rise, there is a significant fall in the amount that can be borrowed. The graph shows that for this particular case, at an interest rate of about 6%, this borrower would be able to borrow about $200,000. However, this falls to about $150,000 if interest rates rise to 8%. If we look at interest rate movements over the last generation, we see that this 2% interest rate change is relatively modest compared to the range of interest rates that we've seen, say, this side of 1970. A change in the interest rate, therefore, has the capacity to make quite a massive change in the amount of money which is going into the pockets of real estate purchasers. While notionally this might be able to put purchasers into different parts of the market, because the interest rates are affecting most buyers, what it means in practice is that when interest rates fall, there is quite a stimulus for the competition between competing purchasers, both knowing that their borrowing capacity is increased, to bid up real estate prices. And this is one of the reasons why interest rates falling can have a strong impact on pushing real estate prices higher. Invariably, the purchasers end up with the largest loan their debt servicing ability can support, which necessarily means that they locate themselves on the high risk end of their personal capacity to service the loan. In earlier times, such as before about 1980, banks would only recognise one income from a household being put towards the repayment of housing loan. However, since that time, banks have accepted the second income as an indication of debt servicing ability. Elizabeth Warren has found that while this increased borrowing capacity, which came from this wider recognition, has certainly been seen as a boom for borrowers, its overall impact was first of all to send prices higher, but then secondly to make households far more dependent on maintaining their second income. Anything which caused the second income to falter meant that those households risked housing default, possibly household bankruptcy. And Warren has found that in the United States, well before the global financial crisis, household bankruptcy was not only on the increase, but it actually exceeded divorce as the most common or the more common event likely to befall households. The psychology of borrowing in a weakly regulated market, therefore, tends to incline housing prices to rise while inclining households to be moving towards high risk situations that is evidenced in the rising levels of bankruptcy. Currently, there appears to be a rising level of awareness that increased excessive indebtedness is a dangerous situation for a household to find itself in, and this is in part resulting in a quieter overall economic outlook. We will be exploring this further in a separate class.